Payments made at the beginning of the year. Aiden Company signs a lease agreement dated January 1st, 2019 that provides for it to lease non-specialized heavy equipment from Scott Rental Company beginning January 1st, 2019. The lease terms, provisions, and related events are as follows. The lease term is 4 years, lease is non-cancelable and requires annual rental payments of $20,000 to be paid in advance at the beginning of each year. The cost and also fair value of the equipment to Scott at the inception of the lease is $68,036.62. The equipment has an estimated life of 4 years and has zero estimated residual value at the end of its time. Aiden agrees to pay all executory costs directly to a third party. The lease contains no renewal or bargain purchase options. Scott's interest rate implicit in the lease is 12%. Aiden is aware of this rate, which is equal to its borrowing rate. Aiden uses a straight line method to record depreciation on similar equipment. Executory costs paid at the beginning of the year by Aiden are insurance and property taxes for each year and the various amounts listed for 19 and 20. And so we need to determine what type of lease this is for Aiden, then prepare a table summarizing the payments and interest expense, and then the journal entries for 2019 and 2020. And so first, we're just determining the type of lease payment that this is. We'll ask ourselves those 5 criteria to figure out if it is either the operating lease or the finance lease. And so the first one is transfer of ownership. And the answer to that is no. Bargain purchase option. And the answer right here, just saw it. Oh, is no. Okay. Lease term is for a major part of its economic life. I guess I should have moved my nose out a little bit. So it's a 4-year lease, and down here we have that there's 4 years remaining. So the answer to that would be yes. And technically, since we have a yes, we could just stop there and know that this is a finance lease. But let's go ahead and finish the other 2 questions. Present value of lease payments and the guaranteed residual value equals or exceeds substantially all of the fair value. I wanted the equal then or greater to, and so I'm just going to abbreviate that a lot. And so we need to determine what the present value of the lease payments, and in this case there is no guaranteed residual value, so we just have the present value of the lease payments, and so we'll use the Excel function over here and say equals PV, open parentheses, rate they gave to us as 12%. The number of periods is the 4 years. The payment is $20,000. And then because the payments are made at the beginning of the year, in this particular present value function, we need to make sure we select 1 for type. So you can just put a comma, and ignore the future value, and then we'll type 1, and then close parentheses, and we get $68,036.63. And so the present value of the lease payments is equal to the fair value at inception. So the answer here is yes. And then our last question is the specialized nature of the asset. And so this is, in full, like if you were to read it straight out of the text, it says the underlying asset is of such a specialized nature that it is expected to have no alternative use to the leaser at the end of the lease term. And that's not the case here. it said non-specialized heavy equipment, so that's a no. And so based on the fact that we have any yes to one of these 5 questions, we know that this is a finance lease, and so that's the answer to our question 1. Then it wants us to prepare a table summarizing the lease payments and then the journal entries. And so the system gives us this kind of format of how they want to see the table of the lease payments. And so we can go ahead and fill this in. And so we're starting with January 1st, 2019, before the initial payment. And so before the initial payment, we have a balance of lease liability of $68,036.63. I'm going to switch a negative here so it puts it in the positive. And just be aware that using the present value function will give you an exact cent. And so it's possible that if you're like using the tables to do that by hand, that you might have your cents might be off like 1 or 2 cents either direction. So just something to be aware of, and it's not something to be upset about, just to be aware of that if like Cengage thinks you're wrong, that might be why that is. So then on January 1st, 2019, we made a lease payment of $20,000, which means that we have a balance of that $68,000 minus the lease payment. And I'm just going to say plus the interest. And I know it's 0 in this case, but doing that will allow us to just pull this formula down so that we don't have to type it every time. And so now we have a balance of $48,036.63. And so now we have to calculate the interest for that year, as of December 31st, 2019. And so that would be equal to our previous balance times the 12% interest rate for $5,764.40. And I'm just going to pull this formula all the way down. And so we have a balance of $53,801. And now we can just plug in our $20,000 at the start of each year, but we'll just take it 1 year at a time. So after that $20,000 payment, we then would have an interest of our previous balance times the 12%, and we're just going to keep doing the same thing. And we can see that it works out to 0 at the end. So that makes sense and is a good sign to us that we did this correctly. And then the third part is to prepare the journal entries for Aiden for the years 2019 and 2020. So we'll start with January 1, 2019. And as of this day, we first need to record that right of use asset. And so the credit that would go with that would be our lease liability. And actually, let me change all of these to comma formatting. And so the right of use asset would be that $68,036.63. Then also on the first, we are going to debit our lease liability, as we can see in our table, and credit cash. For that $20,000. Then on December 31st, we need to record our interest expense. and that's going to be a a credit to our lease liability to increase that liability. And we can pull this straight out of our table. Also on the 31st, we're going to amortize the expense, and so we will have here amortization, this is the 31st, amortization expense, right of use asset. And so this is going to be equal to the whole 68,000 divided by 4. So we'll say equals that 68,036 divided by 4, and we get 1709.16. And then finally on the 31st, we also need to show this insurance and property tax that was paid. So we have insurance expense, property tax expense, and cash. And before I do that, I'm going to just run back up. It said that the executory costs were paid at the end of the year by Aiden. And so that's why we know we need to include these as expenses. And we have $1,500 and $5,500. For a total of $7,000. Then we have January 1, 2020. And so this time we're not going to record this initial right of use asset, obviously, because we already recorded that, and we're just going to amortize it at the end of each year from this year going forward. And so we're just going to start out with our lease liability and cash. And we can just come up to the table, pull that 20,000. Then December 31, we're going to have the same thing where we have an interest expense, liability, amortization expense, right of use. So I'm just going to pull all of these down. And then the interest expense, we're going to come up to our table and take this 4,056.12. Our amortization expense will be the exact same as last year because it's straight line, so it's just the same for every year. And then the insurance, we need to come up, it was $1,300 and $6,000 this year. And I think let's just double check that it only tells us to do those 2 years. Yeah, 19 and 20. However, we have the information. So if we need to do 2021, it would be the exact same thing, except obviously our interest expense would be $2,142, and we don't know about the insurance and the property tax. And that concludes this problem.